and welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Absolutely, Sarah. It's great to be here.
So with all the buzz around mortgage rates and predictions for 2026, it's a really exciting time for real estate investors, or at least it could be if you know how to navigate it.
Right, and understanding these predictions can really influence your investment decisions, whether you're looking to buy, sell, or hold.
Exactly. Today, we're diving into how these future mortgage rate predictions could impact your investment strategy and what you can do to prepare.
We'll also touch on some practical tips for building long-term wealth in real estate, even if you're starting later in life.
Yeah, and we'll share some personal stories too, because we all know that investing isn't just about numbers. It's about real experiences.
That's the truth. And I think it's important to remember that every investor's journey is unique.
Absolutely. So whether you're a seasoned pro or just dipping your toes into the market, stick with us because we have a lot to cover that can really help you make informed decisions.
Let's get into it then.
Great. So first up, let's talk about these mortgage rate predictions and what they really mean for investors like you.
You know, Sarah, when we talk about mortgage rates and predictions for 2026, it's not just about numbers on a screen. It's really about how those numbers affect people's lives, especially for our listeners who are over 40.
Absolutely, Mike. I mean, for someone in their 40s or 50s, those upcoming years can feel like a huge turning point, right? It's that time when many start seriously thinking about retirement and how their investments will support them then.
Exactly. And with the current economic landscape, it's crucial to consider how inflation is impacting purchasing power. I mean, look at how prices have been rising. If your savings are sitting in a bank account, they're losing value every day. Real estate, on the other hand, can be a hedge against that inflation.
Right. Like, if you own an investment property, the rent you collect can increase over time, often outpacing inflation. It's a way to ensure your income keeps up with rising costs.
And let's not forget about market shifts. We've seen fluctuations in the past, and they can be daunting, but for those who are prepared, it can be a golden opportunity. For instance, I know an investor named Tom. He bought a duplex just before the last major rate hike, and while the landscape was scary, he managed to secure tenants who paid above market rent.
That's a great example. It's all about timing and being strategic, isn't it? I've also heard stories of people who sold their primary homes, took advantage of the market, and used those profits to invest in multifamily properties. It's like a wealth transfer strategy that not only benefits them, but also creates a legacy for their families.
Exactly, Sarah. Wealth transfer is a big deal. Many of our listeners are thinking about how they can create a financial foundation for their kids or even grandkids. Setting them up for success. Real estate is often a more stable investment compared to stocks, especially in uncertain times.
And that emotional side of financial security, it's something that often gets overlooked. People want to feel secure, especially as they approach retirement. Knowing you have a tangible asset, something you can see and manage, can really ease that anxiety.
Yeah, it's that peace of mind. I once spoke to a woman named Lisa, who was worried about her retirement savings. She felt vulnerable with the market volatility. But after investing in a rental property, she found a new sense of confidence. She realized that regardless of what happened in the stock market, she had this solid asset-producing income.
That's so empowering, and it highlights the importance of diversifying your investment portfolio. Especially for those of us over 40, it's about building a balanced approach, isn't it?
Absolutely. The current economic trends show that many people are moving toward real estate as a more stable investment. The demand for rental properties is on the rise, partly due to the increase in people looking for flexibility in their living situations.
Yes, and with that trend, it's creating a stronger rental market. Investors can capitalize on this by securing properties that are in high-demand areas. Imagine being able to provide a home for someone while also building your wealth. It's a win-win.
Exactly, and for those who may be hesitant, I often remind them that starting small can lead to big opportunities. Like, if you can't afford a multifamily unit right away, consider a single-family home in an up-and-coming neighborhood.
That's so true. It's all about taking those first steps. And for someone who may feel overwhelmed, Breaking it down into manageable pieces can make a world of difference.
And think about the long-term benefits. Real estate is not just about immediate cash flow. It's about building equity over time. The longer you hold on to a property, the more value it typically accumulates.
And with interest rates projected to shift again in the coming years, it's essential to lock in a good mortgage rate now if you can. Those who wait might find themselves facing much higher costs down the line.
Right. It's like playing a game of chess. You want to make your moves strategically, anticipating what's coming next. And with the right research and planning, you can set yourself up for success.
And here's a thought. What if someone is thinking about selling their home to downsize or to get into investment property? That could also be a part of the wealth transfer strategy we talked about.
Exactly. It's about being proactive. If someone is considering downsizing, they should think about how they can use the equity from their current home to invest in something that will serve them better in the long run.
And that's an opportunity to not only simplify their lives, but also to create a potential income stream. It's really about aligning their current situation with their future goals.
Yes. And for anyone feeling uncertain about their financial future, taking these steps can be incredibly empowering. It's about seizing control rather than letting circumstances dictate your situation.
And as we move forward in this episode, let's dive into some core strategies that can help our listeners make informed decisions about their real estate investments, especially as we look toward 2026.
So let's dive into some core strategies that can really help our listeners navigate this unpredictable market. You know, having a solid game plan is essential, especially as we look ahead to 2026 and the potential for rising mortgage rates.
Absolutely, Mike. I think one of the first rules of thumb we should discuss is the 1% rule. It's pretty straightforward, right?
Yeah, exactly. The 1% rule suggests that the monthly rent you can charge for a property should ideally be at least 1% of the purchase price. So if you buy a property for $200,000, you should aim to rent it out for about $2,000 a month.
Right. And that gives investors a quick way to gauge whether a property might be a good investment or not. But, it's not the only metric to consider.
Exactly. It's a good starting point, but you should also look at the 50% rule, which is another key indicator. This rule states that about 50% of your rental income will go towards operating expenses. So if you're expecting $2,000 a month in rent, you should budget around $1,000 for expenses.
That makes sense. It's a simple way to ensure you're not overestimating your cash flow. Are there other metrics you think are crucial?
Definitely. Cap rates are another important one. The capitalization rate can help you evaluate the potential return on an investment property. You calculate it by taking the property's net operating income, basically the income after expenses, and dividing that by the property's purchase price.
So if you have a property that generates $30,000 a year in net operating income and you bought it for $300,000, your cap rate would be 10%. That's a solid return, right?
Yeah, it is. A higher cap rate usually means a better return on investment, but it can also indicate more risk. So it's essential to balance that with other factors like location and property condition.
Speaking of location, how important is that in the current market?
Oh, it's vital. The right location can make or break an investment. Look for areas with strong rental demand, good schools, amenities, and potential for growth. You can often find these insights by researching local economic indicators like job growth and population trends.
And what about financing options? I mean, with mortgage rates expected to rise, what should investors be considering?
Great question. It's crucial to explore different financing options. For instance, some investors might consider adjustable rate mortgages, especially if they plan to hold a property for only a few years. The initial rates can be lower than fixed rates, but you have to be cautious about future rate adjustments.
Right, and that's where the long-term strategy comes in. If you're planning to hold a property for a while, a fixed-rate mortgage might provide more stability, even if the initial rate is a bit higher.
Exactly. And don't forget about conventional loans versus government-backed loans like FHA or VA loans. They each have their pros and cons, so it's worth doing your homework.
For sure. And then there's the idea of leveraging equity in other properties to finance new purchases too, right?
Yes, if you have equity built up in your current properties, you can tap into that for down payments on new investments. It's a strategy that can really help you grow your portfolio, but you need to be careful about over-leveraging.
Definitely. So let's talk about evaluating deals. What's your checklist for assessing a potential investment?
Well, I usually look at a few key factors: the purchase price, the expected rental income, local market trends, cash flow projections, and potential for appreciation. Having a checklist helps streamline the decision-making process.
And you also have to factor in the property condition, right? Sometimes a seemingly great deal can turn into a money pit if you're not careful.
Absolutely. A thorough inspection is essential. You want to know what kind of repairs or renovations you might be facing. I'd recommend budgeting a bit extra for unexpected costs, too, just to be safe.
That's solid advice. Now, what about property types? Are there certain types of properties that are better suited for investors, especially in a fluctuating market?
It really depends on your strategy and risk tolerance. Single-family homes are often easier to finance and manage, while multifamily units can provide better cash flow, though they may require more hands-on management.
And then there's commercial real estate, which can be a whole different ballgame.
Exactly. Commercial properties often require more capital upfront and can have longer vacancy periods, but they can also yield higher returns if you do your homework.
So much to consider. It can feel overwhelming. But if investors stick to these core strategies and take it step by step, they can really set themselves up for success.
For sure, but it's also important to keep an eye on common pitfalls.
Right. What are some of those pitfalls that investors should watch out for?
Well, one major pitfall is not doing enough due diligence. Skipping inspections or failing to thoroughly research the local market can lead to costly mistakes.
And then there's the danger of over-leveraging, which you mentioned earlier. That can really put you in a tight spot if the market turns.
Exactly. And don't forget about the emotional side of investing. It's easy to get attached to a property or feel pressured to make a quick decision, but that can lead to regret down the line.
Yeah. Staying level-headed and sticking to your strategy is crucial.
Definitely. So as we wrap up this section, it's clear that understanding these core strategies and being aware of common pitfalls can really help investors navigate the evolving landscape of real estate investing.
Absolutely, Mike. There's so much potential, especially for those who are informed and prepared.
You know, Sarah, one of the biggest pitfalls I see with investors, especially those who are just starting out, is over-leveraging. It's such a tempting trap. They see potential profits and think, if I just borrow a bit more, I can get that dream property.
Right. I mean, it's easy to get caught up in the excitement of a deal. But what happens when the market takes a downturn or unexpected expenses arise?
Exactly. I had a client once who bought a property with a very tight margin. They stretched their finances to the limit, thinking they could renovate quickly and flip it for a profit. But then, surprise, they uncovered serious plumbing issues that ate into their budget.
Oh no. So they ended up with a property that was costing them more money than they anticipated?
Yes, and they had to decide whether to keep pouring money in or cut their losses. They ended up selling at a loss. If they had just been a bit more cautious with their leverage, they could have avoided that situation entirely.
That's such a valuable lesson. It really highlights the importance of understanding your financial limits. What about bad tenants? I know that can be a huge headache for property owners.
Oh, absolutely. I had another investor who was really focused on cash flow, and they thought they could just rent to anyone willing to pay. They didn't screen their tenants properly.
Yikes! What happened?
They ended up with tenants who paid late, and then when they did finally move out, the place was a disaster. They had to spend thousands on repairs and cleaning. It was a nightmare.
That's such a common mistake. I think people sometimes underestimate how important it is to find the right tenants.
Yeah, and it's not just about avoiding the bad ones. It's also about finding tenants who will treat the property well. I always advise doing thorough background checks, checking references. It saves a lot of headache down the line.
That makes so much sense. And what about cash flow? I assume that's a crucial aspect that some investors overlook.
Definitely. I've seen investors buy properties thinking they'll just rely on appreciation, ignoring the cash flow aspect entirely. They might have a great property in a growing area, but if it's not cash flow positive, they could find themselves in trouble.
So they're basically banking on future value without a solid income in the meantime?
Exactly. I had one investor who bought a stunning property in a trendy neighborhood, but the rent couldn't cover the mortgage and other costs. They were barely breaking even each month. When the market turned, they were in a tight spot.
That's tough. It's like they put all their eggs in one basket.
Right, and it's so important to have a cushion for those unexpected expenses. A good rule of thumb is to aim for properties that generate at least 1% of the purchase price in monthly rent. That way, you have a better chance of covering costs.
That's a solid guideline. Speaking of unexpected expenses, what hidden costs should investors be on the lookout for?
Hidden costs can really catch you off guard. Things like property taxes, homeowners, association fees, maintenance, and repairs. They can add up quickly. I had a friend who bought a property that seemed like a steal, but he didn't factor in the HOA fees.
So it ended up being much more expensive than he thought?
Exactly. He thought he was getting a great deal, but those fees meant he was barely cash flow positive. It's crucial to do your homework and factor in all the potential costs before making a purchase.
And what about timing the market? I think a lot of investors get stuck trying to predict the perfect moment to buy.
Oh, that's a classic pitfall. I've seen investors wait for months, even years, thinking they'll catch the market at its lowest. Meanwhile, properties they were interested in just kept appreciating.
So they missed out on opportunities?
Totally. You know, the market will always have its ups and downs, and trying to time it perfectly is nearly impossible. Instead, I encourage investors to focus on their own readiness. Is their financial situation stable? Are they prepared for the responsibilities of owning a property?
That's really wise advice. So it's less about the exact timing and more about being prepared?
Yes, and if you find a good deal that meets your criteria, don't hesitate. You can't control the market, but you can control your actions.
Such a great reminder. And I think it's also important to keep an eye out for red flags early on. What should investors be looking for?
Well, first off, if a property has been on the market for a long time, that could be a sign that something's off. And then there's the condition of the property itself. Are there obvious maintenance issues?
Right, and sometimes sellers might try to hide problems.
Exactly. I always tell investors to get a thorough inspection. A good inspector can help identify potential issues that might not be immediately visible.
That's really crucial. It's like getting a second opinion before making a big decision.
Absolutely. And even doing your due diligence on the neighborhood can tell you a lot about potential future issues. Are there a lot of vacancies? What's the crime rate like?
Those are all important factors to consider. It's like peeling back the layers to get the full picture.
Exactly. And if something feels off, trust your gut. It's better to walk away from a deal than to get stuck in a situation that could cost you in the long run.
Such great advice, Mike. So to wrap up this section, what would you say are the next steps for anyone who's feeling a bit overwhelmed or worried about these pitfalls?
Well, first, take a step back and assess your financial situation. Make sure you're not over-leveraging. Then, do your homework on properties and neighborhoods. Don't rush into anything.
And definitely screen tenants thoroughly.
For sure. And remember, it's a long-term game. Stay focused on cash flow and don't try to time the market. If you approach it thoughtfully, you can navigate these challenges successfully.
That's such an encouraging perspective. Thanks for sharing these insights, Mike.
So now that we've talked about mortgage rate predictions and what they could mean for investors, let's dive into some immediate, actionable steps that you can take right now to get ahead.
Yeah, I think that's super important. It can feel overwhelming, but starting small can really make a difference. What's the first thing you'd recommend?
Well, I'd say, the first step is to really familiarize yourself with the market. I mean, tools like Zillow or Realtor.com are great for browsing listings and understanding what's out there.
Right, and you can get a good sense of pricing trends in your area too.
Exactly. And then there's the Bigger Pockets calculator, which is fantastic for analyzing potential deals. It helps you understand the numbers behind a property and see if it makes sense for you.
That one's a game changer. I found it really helpful for figuring out cash flow and expenses.
Absolutely. Another tool I love is Deal Check. It's similar, but it also allows you to compare multiple properties side by side, which can save you a lot of time when you're evaluating options.
That's so useful. And what about rent analysis? I know that can be tricky.
Good point. For that, Rentometer is a solid choice. It gives you a quick look at rental prices in your area based on similar properties. Super handy for any investor looking to maximize their rental income.
And local MLS access is invaluable too, if you can get it. Being able to see the most current listings and sold data can really give you an edge.
Definitely. Having that local insight keeps you informed about what's happening in your area, which is crucial. Plus, it helps you spot trends before they become obvious to everyone else.
So if someone's starting from scratch, maybe they should set a goal to analyze one deal per week?
Yeah, that's a great habit to start. Even if it's just looking at the numbers of a property that interests you, it builds your confidence and sharpens your skills.
And connecting with others is important too, right?
Absolutely. Joining a local real estate meetup can be a fantastic way to network, share experiences, and gain insights from those who are already in the game.
I think a lot of people underestimate the power of community. Just hearing about others' journeys can be really motivating.
For sure. Another option is to dive into some books or podcasts focused on real estate investing. There are so many great resources out there.
Oh, totally. I love reading books like Rich Dad, Poor Dad or The ABCs of Real Estate Investing. They really lay the groundwork for understanding investing principles.
And podcasts like Asterisk, Bigger Pockets Asterisk, or Time the Real Estate Guys can offer real-world stories and strategies that you can apply. It's like having a mentor in your pocket.
Exactly, and those stories can really inspire you to take action.
And remember, it's all about starting where you are. You don't have to have everything figured out at once. Just take one step at a time.
That's so true. Even if it's just setting a small goal for yourself, like reviewing one listing or talking to a fellow investor.
Right. And keep an eye on your local market trends. Make it a habit to check in weekly or even daily if you can. You'll start to notice patterns.
And once you feel more comfortable, you could consider reaching out to local real estate agents or property managers. They can provide insights that you might not find online.
Exactly. Building those relationships can open doors to off-market deals or insider knowledge that's invaluable.
So with these tools and habits in your pocket, you're really setting yourself up for success.
Definitely. It's all about creating a routine that works for you and allows you to build your knowledge and confidence in real estate investing.
And as you keep moving forward, remember that every small step counts.
So, those are some practical first steps. Now let's bring this all together. So, to wrap up our discussion on the 2026 mortgage rate predictions and how they might impact investors, I think one key takeaway is that, we should all be prepared for a potentially volatile market.
Absolutely. And it's important to keep an eye on those rates, right? They can really influence not just your buying power, but also the overall investment landscape.
Right. And another point is that while rates might rise, it doesn't mean opportunities disappear. In fact, it can create more chances for savvy investors who are ready to act.
Yeah, and being strategic about financing options is crucial. Like we mentioned, exploring fixed-rate mortgages or even creative financing could really make a difference in the long run.
And let's not forget about diversification. It's always a good idea to have a mix in your portfolio, maybe look into different markets or property types to balance out that risk.
Exactly. It's all about being proactive and informed. Building wealth through real estate is a journey, and staying adaptable is key.
So, for everyone listening, remember that investing is a marathon, not a sprint. With the right mindset and approach, you can definitely create lasting wealth.
Speaking of staying engaged, if you enjoyed today's episode, don't forget to like, subscribe, and drop a comment with your biggest takeaway or any questions you might have.
And if you know someone over 40 who's thinking about diving into real estate, share this episode with them. You never know who might need that extra nudge.
Next time, we'll be exploring tariffs and supply chain issues and their effects on construction costs. That's going to be a fascinating discussion, so you definitely don't want to miss it.
Yeah. We're looking forward to that. Thanks for joining us today, and keep pushing towards your property goals.
Take care, everyone, and we'll see you next time.